Okay, so let's take a look at U.S. stocks. U.S. stocks moved higher again during April, reaching fresh all-time highs, the first time since September 20th, 2018. Primary drivers of returns for U.S. stocks were corporate earnings coming in better than expected. In aggregate, companies that have reported thus far growing earnings at 1.6% year over year, much better than expectations for a 4% decline year over year. And the other driver were signs that investor sentiment has become increasingly bullish. Foreign stocks also moved higher during the month despite persistent U.S. dollar strength. The primary driver of positive returns was Chinese economic data, which came in better than expected for the first time in quite some time, and perhaps is an early sign that recent monetary and fiscal stimulus is starting to take hold and stabilize economic growth. In late March, U.S. Treasury rates reached their lowest levels of the year due to fears of a sharp slowdown in U.S. economic activity, signaled by an inversion in the yield curve. Going into April, interest rates rose for much of the month, showing that maybe some of those fears of a sharp slowdown in economic activity were a bit overblown. And that idea was ultimately confirmed by Q1 GDP growth, which came in better than expected at 3.2%. During times like this, when short-term moves in the market become increasingly determined by investor sentiment and are even harder to predict than normal, we rely heavily on the wisdom of our longer-term models, which, looking at economic data points and market data points such as the slope of the yield curve, cyclically adjusted PE ratios, tightness of the labor market, all these variables suggest a very difficult environment for U.S. stocks over the next 3 to 5 years.